Hey everyone, welcome back to Yuri's Box. In this video, I'll be going over some of the economic data we got over the past few days. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So first off, I want to just thank everybody that's been interacting with the channel. We're up to 200 subscribers. Again, thank you to everyone. I'll be doing my best to try and make these videos as enjoyable as possible. Hopefully, I'm working on trying to be a bit more relaxed on when being recorded. That is, and also I changed some of the settings on the audio, so hopefully it doesn't sound like you can hear my bowel movements when I'm recording. Hopefully, you can let me know how that is going, and if I have to adjust, I will change a few settings here and there to make everything a little bit more enjoyable again. So thank you again. And really, the highlight of the week, as I said in the week ahead video, we're going to be initial jobless claims and continuing claims, and another round of surveys. All right, I think the best place to start is with the surveys coming out of the Richmond Fed regional survey for both for manufacturing and services, and another read on the regional index for services coming out from the Dallas district. And let's jump right in. So these Richmond surveys are quite brief. There's nothing really too much to stress about. Overall, you continue to see a continuation of what what we've been going over here on the channel ever since February, really. I've been speculating that ever since February, we came out of the artificial, quote unquote, highs that were caused by a lot of transitory events. You had, definitely tariff front running, natural disasters, and port strike fears throughout September, and as well the holiday season, which definitely gave the economy a big boost, but probably made the economy look a little bit better than it was, and inflation look a little bit worse than it was. And again, this regional survey continues on that note. So just to jump right into it, Fifth District Survey Service sector activity slowed in May. Revenues index fell. Indexes for future revenues demand edged up slightly. But again, business conditions, although they have increased, they're still negative. And I think this is quite consistent also with what we've been reading in the previous reports, meaning we went from having an effective trade embargo with China to something that is a little bit more manageable, meaning we have 30% tariffs on China. Now, again, I know today was kind of a funky day because we had, tariffs getting pulled back because of court order, and then tariffs being reinstated as the appeal goes through. More tariff drama. We just keep on making lower highs on the tariff drama as far as I'm concerned. But regardless, the idea is that you go from, again, trade embargo to something that's a little bit more manageable. Again, it's definitely not good news, but it's not the worst case scenario anymore. So that probably pushes, makes everybody just breathe a sigh of relief, just to keep things short. Current employment decreased from 8 to 0. Wages index increased, and average growth rates of prices paid and prices received relatively unchanged. All right, and I'll just keep this here for a second and you can go through the numbers yourself. What you really want to look at, again, as far as the non-farm payroll report, is potentially, again, the number of employees, which is ticked down a bit. And on the inflation front, the prices paid and prices received, this isn't anything new, really, if you've been watching my channel so far. Now, going on to the manufacturing, rather, survey, more of the same, really. Business conditions decreased, although future indexes for shipments and new orders increased substantially. The index rose from minus 20 to 2, positive 2, and new orders increased from minus 26 to negative 3. And again, consistent with the idea of, not having to deal with an effective decoupling. All right, now 30% tariffs is bad. I'll stress that again, but it's not as bad as a total embargo. All right, so at the very least, everybody's just breathing a sigh of relief. And again, here, average growth rates of prices paid and prices received were nearly unchanged in May. All right. Something I will note straight away. If you recall what we read in the S&P PMIs and the various surveys we saw last month, you did have more pessimism, but the employment picture looked okay. Now you kind of have the opposite. Like now you have, the outlook getting a little bit more rosy because again we don't have a total trade embargo on the table anymore, but at the same time we don't have that employment part of the picture really holding in there. I mean, the S&P PMIs mentioned this briefly of seeing decreased, only slightly decreased payrolls. Richmond Fed surveys indicate that as well, through the indexes right here. This is for services. Indexes decreased from 8 to 0. And for manufacturing, the same. Where did I read that? Right here. What was that? Number of employees, right here. Well, this got a little bit better right here on manufacturing, but it's still in negative territory. Overall, again, the picture is that, yes, the outlook is slightly better, but the employment picture doesn't seem to be, following, getting some follow through on that. That's just some food for thought, for the upcoming non-farm payroll report. After that, we got Dallas Fed. This, just on a superficial level, was a little bit more gloomy, if you ask me. Texas service sector activity contracted in May. Revenue index fell 9 points. Labor market measures suggested both employment and work weeks were unchanged in May. Employment index increased rather from negative 0.2 from negative 5.1, and part-time employment edged up slightly again. Perceptions of broader business conditions worsened in May, but uncertainty moderated, again playing into the theme of we don't have a trade embargo anymore, right? So it's at the very least it's manageable. It's not good. It's not good. It's far from best case scenario, but it's not the worst case scenario. All right. General business activity index rose but remained in negative territory. The outlook uncertainty fell sharply again from 40 to 19. The retail outlook was really the kind of the bearer of the bad news here. Retail sales contracted sharply in May. And again, I'll leave this here so you can go through it for yourself. Really, this isn't anything new. I don't really want to stress this too much because, again, these regional surveys, it's kind of like a collage. You're putting all these pieces together, and overall, they continue to say the same thing. Right? We're still in the same environment as we were, just with perhaps the biggest risks. That was my first sneeze on while recording. Pardon me. But again, we continue to have this the same messaging really coming from these regional surveys. And again, look through it yourself. Labor market indicators suggested continued contraction in employment and work weeks. Not great. All right. And again, I think that the general theme that I think is most fitting is that, tariffs didn't start it, and good news on tariffs won't end it. All right. This was already in play well before tariff drama. Tariff drama probably made it worse, and it'll take more than some fuzzy news regarding trade deals, which, by the way, we still haven't got any. All right, we have maybe the UK, maybe, uh, but I don't really know of any progress on any other front. If you ask me, though, again, this is what you wanted to look at this week right here, and I jump right into it. Estimates were for 220 or 230 on initial jobless claims. Now we had an upside surprise to 240. Now, again, the way I treat initial jobless claims is really a proxy of where the unemployment rate will be, right? Simply put, if you see initial jobless claims print somewhere between 215, right, anywhere below 215, you can generally expect the unemployment rate to come in lower, right, to come in lower the next month. Anything that's above 220, 225, you can expect the unemployment rate to tick up. Now, we've been above 225 also ever since week of April 21st. And that is quite significant because, again, I'll come out with my forecast tomorrow. I'll think about it for another day and I'll give you my forecast. But again, we're still above 225, and that to me at the very least suggests that the unemployment rate is going to go up. All right. I'll go in further detail tomorrow, but again, just to keep things simple and short, I'm expecting the unemployment rate to go up tomorrow, next week. All right. So again, initial jobless claims going up, and again, just to stress this, we are still at, historically, we're at very, very low levels here. For just to put everything in the right context here, the cycle lows for the 06, 08 cycle was about 280. If we got to 280 right now, everybody would start, there'd be blood in the street, but we're nowhere near that. Okay, so that is always good to keep in mind. What is also good to keep in mind is that just because initial jobless claims are low, that is not a good enough of a reason to be complacent about the economy. If you're waiting for initial jobless claims to break out, the analogy I use is that if you're waiting for initial jobless claims to break out in order to cut rates, per se, that is like saying, I'm going to wait before I shower until I smell like rotten eggs. All right. By the time you smell like rotten eggs, you should have taken a shower, a long time ago. Same thing for policy interest rates. If you're saying that we don't need to cut rates because initial jobless claims are low, you're gonna be late. Full stop. All right. By the time initial jobless claims break out significantly, you're well in a recession, and by the time they peak, you're at the end of the recession. So you really have to shift the way you view about this. In my opinion, this is quite popular. I see this being spoken about a lot, and again, I could easily be wrong about it. There could be some nuance, some fairy dust I'm missing here, but as far as my interpretation of things go, the first part of the recession isn't job loss. The first part of a recession is low hirings. All right. When the hiring rate kind of fizzles out, and it kind of, fizzles out is the right expression. That's when you have to start to get worried. Right. The second part, the final part, is job loss. That's what everybody associates a recession with. All right. But again, to keep things short, don't really get too complacent about initial jobless claims at these low levels, because again, if we were to see a breakout, it would be already game over at that point. All right, so keep that in mind. Keep both things in mind. Also, we also had continuing claims. Now, the way you should think about initial jobless claims, in my opinion, is in relation to job openings. All right, I'm not a great fan of job openings as a data set, but again, if you really wanted to consider them, I think this is the way to go. And why would you put them in relation to continuing claims? Well, the rationale is quite simple. as job openings decline, it's harder to find a job. And as job openings decline, and the harder it becomes to find a job, you're going to probably spend more time unemployed. All right. And again, I've been arguing for a potential breakout. Again, I was never going to do technical analysis on continuing claims. That's a no. But again, to me, this just looked like a consolidation, if you will. And I continue to argue that we're probably going anywhere between 2 and 2.1. Again, if we continue on this path, if you will, of controlled demolition, because again, we usually kind of have a breakout, then we consolidate, breakout, then we consolidate. We could just break out to 2.2, 2.1, then consolidate around here. But if something else is going on in the background, you might not consolidate and just shoot right up. Just look at 06 and 07 as a potential example of what might come out of a huge breakout on continuing claims. So again, just to keep everything in the right context here, we're still at very low levels historically speaking. But again, that is not a reason to be complacent, in my opinion. And another way you can look at this is the number of unemployed people for 27 weeks and over. I believe we're gonna get another update on this on the non-farm payroll report, but I could be mistaken. Regardless, this metric as well is on the uptrend. All right. So again, the way I characterize the environment in which we are, it's a low hire, low fire. And it's a slowdown. It's not a depression. It's not a recession. And it's just a slowdown. All right. And as I've pointed out in my previous videos, we already have had some data hint at the fact that, job losses actually started in, Q3 of 2024. All right. Right. Here's the link. You can look at it for yourself. All right. Numbers speak for themselves. And again, these are the revisions. And the problem with the numbers that we get at the beginning of each month, and I'm going to stress this every time, but it's that they are unreliable at best. All right, because we get revisions we'll be getting revisions for April, and only in in 6 months time will we be getting probably revisions for this quarter, for Q1. And again, we might be knees deep in a recession by then, and they just backdate it. But that's just how these things go. So it's important to remember that it's difficult to time this sort of stuff, right? Simply because the data that we have to deal with is evolving, and it evolves in with quite a lag, that is. All right, so keep that in mind as well. And this was really the highlight of the week for now. Tomorrow we also have some PCE PCE coming out tomorrow. That is the preferred inflation metric by the Fed. We'll see how that comes out. It should be quite tame, considering that we had CPI and PPI come in quite soft, so it should be tame. But again, it's always best to prepare for the worst. And just to give you a sneak peek of what I'll be talking about tomorrow on TLT, TLT sits in quite a peculiar and interesting spot, in my opinion, because again, we have broken out for the moment out of this trend line. Probably better on a daily chart. All right, you can see it quite clearly. We're on this trend line that we started on Friday 4th, April 4th, and we're currently breaking out of it. All right, that's score one for TLT. All right, and granted, we're 6-0 at this point in football terms, soccer terms, but 6-1. But again, another thing you could point at is that we bounced precisely off of the lower bound of this falling wedge, if you will, which is also interesting. Again, I'm personally prepared for the worst. That's the way I operate. I'm prepared for a sweep of the previous low. And again, does it have to happen? No, but that's the way I'm operating. I'm acting as though it's gonna happen. And if it doesn't happen, all the better. But if it does, I'm ready. So also the RSI. The RSI continues, this divergence I pointed out last week for the moment. Seems to be holding up quite well. But I will be going into further detail tomorrow in the weekly close video, where I also give my forecasts, just for fun and games on the upcoming non-farm payroll report. Hopefully you enjoyed this video. Hopefully the audio was better. Again, do tell me in the comment section if you hear any bowel movements or or anything else, anything that is definitely undesirable when listening to a video. Again, doing this for you. Hopefully, these videos become more enjoyable as time goes on. Again, if you enjoy this video, leave a like, subscribe, and I'll see you next time. Bye.